Well, hello everyone, I'm Steve Savant and welcome to my quarterly webinar entitled New Journey Guide Income Planning Software that Increases Annuity Sales. It's all about selling with science and marketing with math. Today's webinar is brought to you by Journey Guide, the premier retirement software program in the country, and by Ash Brokerage, the largest independently owned marketing organization in the nation, and of course, Insurance WebEx, our online international distribution partner to financial professionals in the U.S. and Canada. Today, our special guest is Michael Smith, who's created Journey Guide, but I just wanted to give you a little heads up. He also designed an asset allocation optimization process that's still in use to determine the model weightings for Goldman Sachs' high net worth clients. And Michael was awarded a U.S. patent for this work. In addition, he holds a bachelor's and master's in mathematics and has taught overseas in math. Quite a resume in my view. Welcome to the show, Michael.
Thanks, Steve. Happy to be here.
Well, I have to say, we did a show on this, and some of you have already written me and said you saw the show. And afterwards, we're going to be able to send this out through Insurance WebEx. We're going to give everybody the opportunity to go and watch the show direct if they want to see it. We're talking about retirement crisis right now, and this software is probably the biggest answer I've seen. It's not just a small adjustment and there's a few tweaks here. We've really seen a quantum change in the way we're approaching math and science as it relates to retirement modeling, especially in a software like this. Our two issues today, and by the way, this is in CNN Money, CBS Money Watch, this is USA Today, Forbes, Fortune, Wall Street Journal. Everybody's talking about the longevity risk right now and how I can quantify that on a platform like Journey Guide. And we're putting that aside with longevity risk, the second problem, which is inadequate funding for retirement. Now, in the traditional sense, I've noticed that most of the software that we've been using for the last decade is cash flow retirement centered. But Michael, in your situation, you've actually changed the entire map in the way we talk about this. You're talking about how to maximize efficient income. So yours is really based on income. Tell me the distinction between the old way, the antiquated way of cash flow retirement, and your new way dealing with it as maximizing income.
Sure. Yeah, that's actually a very important distinction, Steve, because the focus really has been traditionally on looking at various cash flows in and out, the investment gains, looking at it from, okay, we need to accumulate to a particular asset amount, and then taking a very simplified approach in terms of distributions. And what we've really tried to focus more on is this concept of income is really the most important part of the discussion. And so the solutions that we're providing and the calculations that we're doing are all focused around determining what is that income amount that they can spend in retirement.
Michael, I want to go to this idea. When we're using Journey Guide, it actually is doing something I have never seen any software done before. Usually when I do a cash flow analysis for retirement, I may have to come back to the client and say, you're going to have to retire at a later date. Or I'm going to have to say, you're going to have to reduce your lifestyle. Or you're going to have to save more money. Or you're going to have to increase exposure to the market. In your Journey Guide, I have seen several scenarios where we thought that funding wasn't adequate, but it was the distribution of income that was the problem. And we were able to keep clients on track without making any of those four modifications. Talk about that, because to me, that is a huge issue.
Right. Yeah. We like to actually refer to those as the sacrifices. So typically that's the response that, and really kind of one of the only tools that advisors typically would have is looking at, okay, possibly reducing the amount that they would spend in retirement, changing the retirement date, increasing the amount of savings to put into the plan. We would like to actually shift that discussion into offering other solutions and seeing, can we reallocate some of those assets into something that might be more efficient to be able to produce a better result for the client and make the plan just that much more stable and clear and allow them to get on a better path for retirement.
Now, when we talk about this, the stunning thing I thought about Journey Guide was when we were making recalibrations and we were changing the asset distribution, I thought, because it seemed to be intuitive to me, that if I send money into the future, that my present income will suffer. But that's not the way it is. Talk about how can we actually use this software where we're actually delaying money into the future, and it's not affecting, actually, it's increasing my present monies. I thought I'd lose money on that.
Yeah, so the focus really is on the most efficient use of those assets and addressing things like longevity risk and sequence of return risk in the markets. And so, when we talk about looking at other options, we're putting it back in terms of how much they can actually spend today, right at the beginning of retirement. But then there are a lot of things kind of go into that calculation and determination. And one of the most important things is how people spend in retirement. And so we've actually done quite a bit of research on this with some leading universities on determining what is the typical spending pattern for people in retirement. And we take that all into account as we're determining how much they can spend. Yeah, so it sounds like that we may have lost Steve on the audio there. So what we're going to do, we'll go ahead and jump, kind of keep the conversation going here. What Steve was starting to talk through was around the Monte Carlo aspects of Journey Guide and the kind of the underlying calculations. And what we've found is that typically the tools that are available today will run either 1,000 simulations, which is, interestingly enough, what we found is that really you need at least 4,000, between 4,000 and 5,000 in order to get an accurate estimation. Anything less than that will typically cause a deviation, very significant in terms of the underlying results for the client. And so we actually are running 5,000 Monte Carlo simulations. And so I think what we can do at this point, we'll go ahead and jump into the software. And so in order to do that, I think the most important thing that we'll focus on here at the beginning is really the simplicity and the ease of use. That's been by far our main focus in building out Journey Guide, is that we wanted to keep the entry of the software as simple as it can be, but as well as, because there are so many underlying calculations that are going on, we wanted to be able to report the results very simply. So that's one of the key drivers and things that we focus on with Journey Guide. And so we have 3 simple screens. The first one is describing more demographic type of information. So this is an example. We have a couple. They're going to be retiring here just in a few years, and they have a goal of spending $100,000 at retirement here in just a couple of years. So the next is the investment information. So they have $2 million investment. It's broken out by their tax type of account. And you can see what the particular asset mix happens to be, and then a target asset mix during retirement. And these are very simple for the advisor to enter. You can do this right there with the client, which is really one of the key aspects of Journey Guide. And then finally, any existing income and expenses that they know that they'll be having. So the key one is Social Security. We're actually currently, if you can just simply put in whatever the amount is on the Social Security statement and indicate what age we'd like to start this, and then we'll determine what is actually the most efficient, whether to take individually, take the spousal benefit. We actually are doing that calculation for you. And then finally, you can include any additional income or expenses. So, you can see we have a drop down of in this case, James is going to be, working part-time for a few years, getting $5,000. and that's an after-tax amount. So they could indicate this either as one-time income flows or annual with a particular rate. So that's it in terms of entry. It's very straightforward. You can do it right there with the client. Now you could imagine that you've entered that information. The advisor can turn that screen right around with the client there and say, okay, well, where are we? Where do we stand? And this is really the key difference that we've seen in the traditional way that advisors typically work with tools, is that a lot of that is done in the back office. And we think that actually there's a more efficient approach. And actually having that discussion right there with the client allows the client to be able to really take ownership of that plan. And so, as you can see, this came back very, very quickly. It was just a matter of a couple of seconds. We actually ran all 5,000 simulations right there. And immediately you can see, okay, can I meet this goal of 100 grand? So in this case, about, almost 88% of the time, so about 8 times out of 10, this client would actually be able to meet that goal. So the key though is that, when we talk about a percentage, that doesn't always resonate with clients. And so what we found is that typically it's hard to kind of digest and understand percentages. And so what we'd like to be able to do is put that back in terms of something that they can understand. And by doing this, you can see, so they want to know, well, what can I spend? If I can't meet my goal, what can I spend in retirement? And immediately right there, we can say, okay, you can't spend 100 grand, but we actually tell you can spend 93,000. And that's an after-tax number. So we've run the calculations. They're all done, again, taking into account many different possible market conditions. And we've done after-tax calculations. So this is really one of the things that sets us apart. We're able to tell the client right away, straight away, what they can spend in retirement. And so the 93,000, so they're not quite there to their goal. So we can see they have a gap of about $6,500 annually. Well, it's at this point that we start to talk about, okay, well, what are those tools that the advisor has in his or her tool belt to be able to get that client to the goal? And typically the discussion is around delaying retirement or possibly saving more prior to that retirement date. But as we said right at the outset, we would rather have the focus of the discussion be on solutions rather than those sacrifices. And so this is really where the fun happens. And so if we go ahead and we click on exploring options, this takes us into a page that you can, again, right there in real time, see what the impact is of making changes to the plan. So on the left-hand side, we have the current plan. And so you can see this is where they currently are in terms of when they want to take Social Security, the asset mix. And any changes then that we make in terms of moving those sliders, we can add guaranteed income streams. We'll see the impact of that on the right-hand side. And so let's actually first just enter in an annuity. And so if we actually have the capability of entering in SPIAs, DIAs, fixed indexed annuities, as well as QLACs and qualified plans. So let's first look at a fixed indexed annuity. And we're going to defer income out 10 years. So in this case, we'll put in just 10% of the portfolio. So what we're doing here is we're reallocating assets out of their non-qualified plan into that fixed indexed annuity. And in real time, we're able to see what the impact is. So right there, by reallocating, we've increased the amount that they can spend in retirement from $93,000 up to $97,000. That's a 4% increase. You can see that right away with the client there what the impact of adding that annuity would be. So it sounds like we might have Steve back.
Can you hear me?
Yes, we can. Welcome back, Steve.
I'm so sorry. I don't know what happened. I was kicked out of the conference for whatever reason. Listen, when you're going, why don't you finish your thought, and then I'll come back to what I want to talk about.
Oh, sure. So essentially, what we've got done to this point is that we've added in a fixed indexed annuity. We put 10%. We've reallocated into that product, and we've seen what the impact can have on retirement. And the key here is showing it's a 4% increase in the amount that they can spend after tax. And then the total amount over the life of the plan. And think about this for a second. That's $152,000. We've just, by reallocating those assets, we've basically extended, that's over a year and a half of additional income that we've provided for that couple. So just a significant, you can see it right away in real time. So Steve, why don't you take it from here?
Yeah, the big thing about this, especially if you believe, as I do a ton of retail seminars and consumer, I want to get in front of the client and be able to demonstrate that the products I'm showing have direct impact on their retirement. And if I'm using a single premium immediate annuity, or if I'm using a deferred income annuity, or maybe even an income rider off an indexed, I want to be able to show the drama of how that can affect my client's actual, not only increase efficient income, but lower my beta risk. So to me, when I see it demonstrated and you look at these summary graphs, it really helps you understand what we're really looking at here. So the first thing is I want to go back to this one thing about the 5,000 simulations, because this is a math issue. John, I'm sorry, Michael, why is this so important to say most of the software we're using is 1,000 iterations. We're doing 5,000. That reduces our actual swing on our percentages.
Yeah, that's exactly, and I touched on it briefly when we had lost you there for a couple of minutes. But essentially, the importance of being able to represent all 5,000 simulations, we're actually doing all 5,000 simulations, is that we're able to then model not only those poor markets, but when those poor markets happen. And the significance of it actually being 5,000, and I know, Steve, we've talked about before that it's interesting, the Navy actually only does 4,000 in some of their ballistics algorithm testing. And so, having 5,000 not only takes us kind of that step further, but the important thing is that we actually then narrow in on that likelihood of success. So instead of the range being much wider in terms of what the possible outcome might be, we're now talking about that spread narrowing in, because it could be as much as 3 to 5% difference, depending if you're only running 1,000 simulations. So that's why it's so important to be able to narrow in on it.
Yes, and I like reducing the mathematical error. I don't like that swing. You just said 3 to 5%. That's too dramatic, really, to be honest with you. That's just too wide. So I'm really following this down now and getting it really, really thinned out or skinnied out. So these numbers are pretty reliable from a simulation point of view. When you're looking at putting an equity number, like we're doing a basic return, I know that you have some thinking behind this, how we get to a point where we're using a 40-60 portfolio with a mean return of 5.1. And I want you to talk about what that means on historical averages and why you came to that conclusion as a mathematician.
Sure. So as we talk about some of the other tools that are out there, and a lot of times the focus is on historical returns and looking at how markets have behaved in particular time periods. And so as you said, from a historical perspective, historically it's been in the 8% and then around 6.9% in terms of equity and bond returns. That we can't sustain those going forward. And so what we're doing is we're actually looking at 10 to 15-year projections. And so we think that the underlying assumptions that we have are much more realistic. But I think which is closer to the 7 and 5% range. But the most important part of that is actually the standard deviation assumptions that are around it. And so if you're only looking at historical averages, you're not taking into account, especially if you're just looking at one average number in your calculations and not even using Monte Carlo, then you're not even taking into account any swings in the markets. And so we're including all of those into this. So for example, we're taking into account those black swan events that we've seen, in the early 2000s, then again in 2008. So that all is encompassed within the calculations and the essentially the results that you're seeing.
Okay, that's a very important distinction that you've incorporated. The 87 hassle, the 2001, 2, and 3, where the S&P went negative 3 years compounded, and then the huge swan event in 2008. So you're saying those numbers are already in there reflecting that?
That's correct. That's correct.
Yeah,
that's already included in the 5,000 calculations.
Now, I'd like to shift a little gear, Michael, if you're okay to go to the tax issue. Did you want to clean up anything before we went to the tax issue?
No, let's go ahead.
Okay. Now, when we're looking at numbers and I say the client comes to you and he says he needs $100,000 a month to spend, we're assuming he means $100,000 after tax. Would you agree?
That's correct.
Okay, but a lot of these plans don't reflect that.
That's right. That's right. So a lot of times what the plan that actually is made is looking purely on a pre-tax basis. And really, if you're only looking at the results on kind of a pre-tax, you're only really having half a discussion. And the most critical, and what we've seen is one of the most impactful components of the retirement discussion is actually the taxation component. And so what we're doing is we're looking, year over year, looking at what the the income that's coming in from Social Security. We know whether it's going to be taxed at either the 50 cents on the dollar, 85 cents on the dollar, as well as what bracket they're going to be in terms of what tax bracket, not only federally, but as well as state. And we also are looking at qualified money obviously is taxed at the ordinary income rate, but non-qualified, we actually are maintaining basis year over year, and so we are keeping track of how much is actually capital gains as well. So all of that is actually built into those calculations, and this is something. Oh, go ahead.
No, I wanted to also say, does it discriminate in such a way on taxes that it can actually pull apart the exclusion ratio of a non-qualified annuity that's paid out for life?
Yes, and that actually is critical in terms of I think the difference in what we're doing. We actually know what the exclusion ratio is on each of these products, and we're taking that into account, which really gives a much more accurate view of the impact that non-qualified annuity can have on the plan. Okay,
so when I'm looking at whether it's taxable, tax-deferred, tax-free, or this homogenization of an annuity payout that carries both principal and interest payouts, we're already accommodating all that. And I think you said, I don't want to put words in your mouth, but when we're talking about Social Security, it's also checking out the Tier 1 and Tier 2 taxation rates.
That's correct. That's correct.
Okay,
we are actually, yeah.
Let's just take an example of this now, because 5 years ago, the United States government, we didn't do this, the industry at large, they invented this thing called Qualified Longevity Annuity Contract. It can only use deferred income annuities. It's the only product. If I delay on your software taking QLAC, and it's qualified, so it's going to be all taxable event there. But if I delay and I'm able to push forward 25% of my qualified plan, not to exceed the 125 limit, am I going to see a direct result? Is it going to incorporate that deferral because my RMD tax is going to come down, and so is my Social Security? Is that going to reflect that using this annuity?
Yes. In fact, we can illustrate that right here for you. So in the example that we have at year 70, so at age 70, obviously we have RMDs that are being impacted. It actually was a couple of years because there are a couple of years difference in age. But you can see at the client's at his age 70, it's a total then of $36,000 in terms of RMDs. And so if we add in the QLAC, Qualified Longevity Annuity Contract, and we can do it actually for one for each of them if we wanted to. So we're going to defer income out to age 80. We're going to actually so reallocate $125,000 for both of them. And actually we can see in real time what the impact is on those RMDs. So again, right there, is the total increase in income. We've now bumped up over our goal. We're now at $101,000, a total of $317,000 increase over the life of the plan. And then if we scroll all the way down, you can see we were at 36,000. Now we're down to 25,000, 25,900. So it's right there. We're representing that deferral of the RMDs.
But let's just go. I want to underscore what you just said. We just deferred money out into the future we actually increased our present income.
Right. Well, what's really interesting, exactly. So we haven't had an impact in terms of having to delay retirement at all. We're still taking income at the same time, right? Obviously, we're filling that gap with assets, pulling from non-qualified in order to fill that gap. But the most critical time to actually make sure that we're not running out of money is on that back end. And so we've actually, provided that. You can see it right there in green coming in from those annuities.
Now that is a huge aspect of that, and I love how it picks up it's the correlation tax issues between deferring our RMDs, the Social Security calculation, and if you're using non-qualified, it picks up the basis during the exclusion ratio years of a non-qualified annuity. I love all that.
That's right.
That's a package. I do not know any other software that does that simultaneously.
Yeah, that's we really felt like we needed to get those calculations right. We felt that was something that was missing in the marketplace. But the key, though, again, just as we said at the very beginning of the webinar, was that our goal of Journey Guide is to make, even though the calculations are complex, we want the result and the entry and the use of this to be extremely simple, and that it can be done right there with the client.
I'd like to shift a little gear about how we're working with registered reps and registered investment advisors who have compliance to deal with. And we live in a very big DOL environment, even though the law hasn't been really instituted. We're all under scrutiny still. Talk a little bit about compliance and why this software is a huge compliance. It is a great companion for compliance and the DOL. Yeah,
so there's many different aspects of that topic that I think we could talk about. I think probably the first and foremost, and this is something that, my background, I was actually at, as you had mentioned at the beginning, I was at Goldman for 17 years, working on really investment and asset allocation optimization. And annuities were not part of that discussion. And so, I came into this with a fairly, closed mind or kind of a preconceived notion of really where annuities would fit. And so I've always been trying to look at what's the cost benefit of including or shifting those assets out of the investment into the annuity. And so that's the reason why we actually came up with this particular graph. So what you're seeing here, we call it the income versus risk graph. And so we're representing all of those simulations, all 5,000 simulations in terms of market conditions on the bottom. So from the unfavorable on the far left, so that's not only poor returns, but as well as poor sequences of those returns, and then favorable on the right-hand side. So, and then what we're doing is we're seeing, okay, well, how much could they spend in each one of these different market conditions? Nobody else has this type of view where they can represent all of that all in one screen. So the blue represents their current plan, so without the annuities. Now, once we've shifted, so as an example, you know, we could spend $150,000 a year, but we'd only have a 10% chance of doing it. 1 in 10 could do it. Conversely, if we spend $98,000, we'd have a much higher likelihood of being able to achieve that. Well, when we shifted those assets into the fixed index annuity as well as the QLACs, then what we've done is, and that's represented by the yellow line, as you would expect in the poorer markets, we can spend more because obviously we're now into a much more conservative type of instrument. But the crossover is really what I was interested in. And so the crossover here is at about 44%, meaning, yes, you're possibly taking on, you know, you're not having quite as much of a benefit in the better markets, but I would have expected that crossover to be much, much further over to the left. And it's not. It's actually further, more than half over to the right. And this is where the conversation with compliance really, I think, is powerful, because we're not saying that the annuity is the best thing in all circumstances. What we're saying is that there's a right conversation, and the annuity fits in the right type for the right client and with the right goals. And so this illustrates it right there. If the client actually wants to take on more risk, okay, then that's understandable, but they need to be able to see what's the trade-off. And so this is really where we think that conversation has the most value.
Now, not that I want to underscore what you said at the front end of this segment here, but basically you're telling me that as a mathematician, you had a bias against annuities without real knowledge. Did I just hear that, or am I just making that up?
Yeah, no, it was definitely a bias against annuities, because now granted, you're right, I didn't really have a kind of a clear picture and understanding where the annuity fits, but it was something that you know, really just from you know, the thought of trying to shift something away from, you know, those investments just did not make sense.
Well, I like the idea that you've come, you're an objective guy, you're a mathematician, you're agnostic about products, and you've had sort of what I could say just short of a financial revelation here, right? I mean, you've had kind of an economic epiphany.
Yeah, I guess you could say that. You could say that, and I think the key is knowing, okay, what is that right amount that should be shifted into these products? Why are we doing that? And you know, we're really doing it to address those risks, and the risks that you see most prevalent in retirement, right? In terms of longevity as well as sequence return, and knowing that kind of the existing methodology is just not working for folks, right? And I think that's really the key, is that the annuity, especially those guaranteed products, they have a place. And they have a place when we're trying to adjust. It's not shifting all of the money into those products, but the right amount is critical, and that's what we're trying to explain here with Journey Guide.
Now, when we're talking about using like QLACs as an example of this, and again, it's powerful because I'm actually not really sacrificing my retirement date many of the times, and I'm also keeping the actual income threshold, what I originally wanted to do, trying to get to that number. But now I can incorporate, if I can, I just wanted to also bring in the idea, because you know we're dropping our beta risk of our portfolio by using SPIAs and DIAs. I mean, we just are. But what about the fees, the financial? Because am I able to plug in the mutual fund and ETF expense loads, not only the expense loads in the prospectus, but the statement of additional information, the cash drag, the RIA fee, if they're doing an ADV fee base. Can I incorporate that into my number to get to a, not a gross rate, a nominal rate, but a real rate of return?
Yeah, so that's exactly right. So you may have noticed, so on the investments page, when we're actually entering in the allocations and what they have in their various accounts, it's there that you would actually indicate what not only the advisory fees, but also any product fees that would be associated with those investments. And so we're taking that into consideration as we're looking at the overall performance or the impact that would have then on retirement. Now, it's interesting though, when we start talking about the annuity products, because we're looking at immediate annuities and deferred income annuities, as well as the guaranteed portion of the fixed index annuities, those are already built into the price of the annuity. So there's no additional fee or drag on those products. They're already built into what you see there. And so, I think that's a key point to raise with that, and that's where it comes in terms of your discussion around beta risk.
Yeah, I think that's a huge issue to bring up, because to get to the net number, to get to the true internal rate of return of using some of these annuity products, you have to really understand that this is a spread product, and those costs have already been rendered. It's a neutral issue for us. So that's a big important thing. Now, before we get into Q&A and some of the questions that we may have, I want you to, Michael, to go over the promotional offer. Tell me your website and give me your toll-free number. So tell me what we're going to offer everybody listening today.
Sure. So what we'd like to be able to offer, or for those that are interested in learning more about Journey Guide, maybe I'll give the website first. So www.journeyguideplanning.com, and so that's we'll actually go to it right here, so you can kind of see what it looks like when you go to it. So bring confidence to retirement. At this point, you could actually request a demo or a free trial. That'll come to us. So as part of this promotion, we're also offering a 10% discount, and again, that would be for the first 10 advisors, that you have within your program. We have the 800 number here, but as part of that promotional, so not only 10%, but as well as an extended free trial. Normally it's 2 weeks, but we're extending that free trial to a full month, so for 30 days. And the 800 number, you can call us directly. 844-427-4576, or you can contact us at journeyguideplanning.com. There's many different ways to reach out to us.
Okay, and what you said, it was 10% off the discount up to 10 years or so. What is a regular subscription cost then?
So it really depends on the number of licenses, and so it just for kind of retail, the top dollar amount in terms of just one license would be $900 for the year, which we actually consider to be a pretty good bargain, kind of in terms of the other software that's out there and what we can actually provide for that in terms of value. But that's what our retail amount is.
Okay, well, before we go to Q&A, I have a couple of my own here, and then I don't know if you guys have any on your side of the fence, but one of mine is, what is the learning curve to understand this software and understand it as an advisor and use it in my daily practice?
Well, and I think we have tried to stress this even through the webinar, but as I was saying, we try to make this as simple and easy to use as possible. So we feel that the entry screens are clearly indicated. We have help kind of bubbles there, as well as a user guide. So we've we tried to make the entry and the ramp up kind of learning of this as minimal as possible. What we suggest and what we would work with you on is walking through a sample case. And so we actually perform the training one-on-one with you, or possibly with the firm. And we'll walk through a sample case and spend that time with you to make sure that you're comfortable with it. The most important thing that we found is actually using, Journey Guide on yourself just as an example right there at the beginning. And we'll actually help you right along that process, even with the free trial.
The second question is if I'm submitting, when I do my plan and I put it in my client file, and every year, all of us who are security licensed are going to be audited. We want to know what am I showing my compliance officer? Am I doing the input pages? Am I doing the summary? What am I showing them to demonstrate I've done this with a quality software package?
So a number of different things. I think the first thing is that maybe we can do is actually show you the dashboard. And so there's a report that actually would be generated from this. And so we could just click on one of those. So remember, we were talking about DOL as well. And so one of the key components of DOL is making sure there's a consistent, repeatable process, even though, it's questionable whether the DOL is going to, actually be in existence. I think the principles are still relevant. And I think it's something that we all want to be able to still follow. And so we produce a report. It's very clean, easy to understand. There are components of this that you can actually modify yourself in terms of the disclosures, but it's all the same type of information that you walked with the client through. And then we can go ahead and skip down to the bottom. And so you can actually see what the underlying asset class assumptions are, as well as the disclosures and disclaimers. Each firm actually have the capability of putting in their own disclosures and disclaimers if they have additional ones that are needed to be there. So it's very flexible in that sense.
Okay. And the last question I have on my end, and you may have some on yours. The last question is when I'm using this, the assumptions that you use are good boilerplate numbers, and you've proven that over your 10-year history and the mean issues that we talked about. Do you recommend these numbers as 5%? Because somebody said to me as they're listening, a friend of mine says, Steve, it seems low. That seems low. I think we're getting better return. And I said, well, I wrote him back saying, I'm not sure, but what's a good number on Journey Guide on my equity side of that equation?
Yeah, so what we can do is actually we could show you what our assumptions are that we're currently using. Yeah, we can actually zoom in. So we have a couple of things that we have as defaults in terms of our asset allocation models. And so what you're actually seeing here are each of the model portfolios that we have by default. Again, the advisor can change those and put in whatever models they want that they have for their particular firm. But in terms of the return and volatility assumptions for each one of our models, those are what you see here. So in terms of stable principal all the way over to all equity, probably the one that's the typical would be a 60-40 model portfolio, where we have a return of 6.2 and a standard deviation of 10. We actually model 16 asset classes, and so those are what you see on the screen here. We would actually, work with those can also be modified, for the firm. And so if you have other assumptions that are, that you have your own investment group, that you have your own assumptions in terms of what equity markets and bond markets will perform, that can also be included into your version of the software.
Excellent. Do you guys have any questions on your side, on the GoToMeeting side?
Yeah, so maybe John, who's here with me, can read some of those questions. You'll have to forgive his accent. We always give him a hard time.
Yeah.
Alrighty. So one of the questions was asked, some fears have a minimum floor of annual interest credit. Does the program get into results from specific products? So we're using asset class and indice assumptions in terms of the for the investments. For the products themselves, for the annuity products, what we're actually doing is we're looking at, and maybe it's important to note kind of the source of the prices of these. So we're using a service where we actually get real-time prices. So these are current prices of immediate annuities as well as the fixed index annuities. For these products, we're actually, again, you can choose either a single or joint, but the most important part here is that these are cash refund products. And they're really just representing or what we call kind of a representative annuity. So we are taking the top 5 and taking an average of those top 5 A-rated companies or higher. So I'm not sure if that addressed the question or not.
We didn't get a response. I'm sure we'll have that question pop up again. So another question was, could you please explain the chart a little bit more fully when it comes to the income versus risk graph?
Sure.
If we jumped into it here and we add that annuity in.
Sure. So yeah, this is probably one of the most powerful things. We want to make sure that we're focusing enough time on it. So again, what this graph is representing is the income that a plan can actually provide across all market conditions. So if we think about, and sometimes we actually think of this as an efficient frontier type of graph, as you think about the risk on the bottom and the return on the going up the left-hand side. But really what we're doing is we're thinking about it in terms of the likelihood or the performance of the markets on the bottom. So in really good markets, way over there on the right-hand side, the blue line represents their current plan. So they could spend $150,000 a year. So what's really good sequence of markets.
And so what's going on is that they're experiencing a positive sequence of returns as well as a strong compound annual growth rate. Is that correct, Michael?
That's correct. So it's a combination not only of the average, of high return number as well as a very favorable sequence of those returns. And then conversely, if we look at a poor market, they just obviously they can't spend as much because they had poor sequence of returns and in those poor markets. But what we're doing here is because we're able to see what the impact of adding on that guaranteed income stream from the annuities, as you would expect in poor markets, the yellow line is then above that blue line because the annuity is a much more conservative type of investment. And it's addressing some of those risks in terms of sequence of return. And so, and then conversely, if we look on the right-hand side, we see that there's, some bit of trade-off. Now, what's interesting is that these graphs are going to look different depending on the individual scenario, for the client. And that's really what I think we are kind of unique about Journey Guide is being able to have this type of analysis, very unique and specific to the client. Now, something that we didn't really touch on, but maybe can...
Yeah, that was a question that was just asked.
Okay.
What's the objective with this graph? Do you want to get the yellow line above the blue line, and how do you do that?
Great segue. So the intention really here, again, it's a snapshot of kind of where they are right now with those plans. But ideally, what we'd like to be able to do is say, well, can we get that yellow line above the blue line in all circumstances, right?
What does that represent?
So really what we're doing is we're saying that, across all market conditions, that they're able to support a higher level of income. So if we close this window and we go back and you think about, okay, we've pulled in this particular situation, we put 20% into that fixed indexed annuity. So we basically reallocated out of a 40-60 portfolio into this fixed indexed annuity. Well, if we then look at the overall, but essentially what we've done there is we've taken 20% of the portfolio into something that's still very conservative or kind of similar to a bond. So now if we then reallocate the remaining assets to something like really bringing it back in line to what would be an overall allocation of 40-60 to a 60-40 ratio, immediately you can see what the impact of that is, and we've gone above in all market conditions. And sure.
So in one sense, are you replacing a portion of the bond portfolio with the annuity, or?
Yeah, so basically what we've done is we've reallocated a portion of their fixed income investments into a product that actually not only provides some of the protection that a bond might provide in terms of sequence of return, but it's much more efficient because it's also addressing the longevity risk aspects. So this is really where I think the power of being able to see the impact of these changes right there in real time can have. And then if finally, and maybe we'll just show this and then go to another question. If we defer Social Security, even further, then we can see, okay, what is the overall impact? And in this case, so not only have we modified their allocation in terms of shifting assets into the risk mitigation type of product, but we've also readjusted their asset mix, and we've adjusted Social Security to really take advantage of that deferral and the growth of 8% by deferring it. We've now exceeded their goal by almost $6,000.
That was a question that somebody asked, could you use this as a Social Security optimization software?
So that actually is something that is probably, again, very unique in that a lot of Social Security optimization tools kind of do it in a vacuum. They only look at Social Security by itself. What we're doing is we're actually incorporating those modifications of when to take Social Security right there along with all other aspects of the plan. And so you're able to see what the impact of changing, maybe just going out to full retirement age or deferring all the way out to 70, but you're seeing it in the context of the entire plan.
And one other question we had was, you indicated you could accurately predict when downturns would occur. Could you elaborate, please? That might be a clarification on the simulations.
Yeah, so essentially we're not necessarily predicting when the downturn will happen. What we're doing is we're simulating what it would look like if a particular downturn were to occur. And so within those 5,000 different simulations, embedded within those are those poor market type of situations. So take the example of somebody actually retiring, when they, in the year 2008. Well, that would have been a poor market year as well as a really bad time to retire. And so that would be one of those particular simulations in terms of the 5,000. So we're not saying that it's, we're not necessarily predicting of when those are going to happen, but what we're doing is we're taking those into account as we look at, okay, how much income can they actually support, in across all of those different types of situations. So I think Steve, we're just coming up to the hour.
Yes, and let's just, before we close out, please repeat your promotional offer.
Sure. So again, it's we want people to come to journeyguideplanning.com, and the promotional offer is 10% off the first 10 users or advisors in your firm, and for the first year, and as well as an extended free trial.
Perfect. Thank you so much. Well, thank you everyone for coming into my quarterly webinar. I think this is the most exciting technology in my 35 years in a long time, and it is one of the greatest solves for using annuities in retirement with math and science. And I think you're going to be proud to be able to bring something to the table that's suitable and compliant in this DOL environment. I want to thank Michael and John for being on with us today. And again, please feel free to call their toll-free number, hit their website, and go ahead and do a demo. It's actually excellent. Until next quarter, I'll see you next time.